Hello, and welcome back to Learn It from a Layman. I'm Carl Christensen, joined again by Cameron. And Matt will be joining us later on, I believe. But today we're going to be discussing banking, or the basics of banking. Cameron, you are essentially rolling in the dough, I believe. So you don't really need a bank.
Bread dough.
What?
Bread dough.
Bread dough.
Bread dough.
different type of dough, but equally useful.
I mean, it is one of the reasons why I hide most of my income under my mattress.
Which will be if you listen to this podcast, that might be what most of our listeners end up doing. So, okay, well, let's go ahead and get started. I guess to start off the podcast, I'll tell you why we're doing banking this week. And those of you in the United States probably know that the Silicon Valley Bank failed. And that was the second largest bank failure in the history of the United States. And it's kind of created a bit of a banking crisis and a public trust crisis in the banks, and highlighted some of the issues. So I thought this would be a perfect scenario, not a perfect scenario, but a perfect time to discuss banking and how we get into this situation and what banks do and how it affects the layman. So I guess also the Silicon Valley Bank was the bank for my company that I work for. And so I get this email Friday night. I see the news stories come out. This is a week ago, and I saw news stories about the Silicon Valley Bank failing. And as most laymen, you probably don't spend a long time thinking about it. I had work to do. So go through my day of work. I'm finishing up, and I get an email from our CEO who says, essentially, everyone stay calm. And I'm like, well, why? Like, what? Anyway, it's this long email about how they were our primary bank, and that he thinks we're going to be fine. That anyway, it all came to a point on Sunday when the United States federal government decided that they would insure all funds for all depositors in the Silicon Valley Bank, meaning that everyone that had deposits in the Silicon Valley Bank would be able to get those from the government, not just up to the insured amount, which we will discuss today about why there are insured amounts of deposits and how that came about. But that is, I guess, my anecdote for why we are discussing banking today and how it's relevant to, even if you didn't have any money in the Silicon Valley Bank, how this could become relevant to you. So, like it became relevant to me. So let's go ahead and dive into the basics of banking. So what is a bank? Cameron, I think you have a piggy bank.
Ooh, I do have a piggy bank. It's a place where I deposit my hard-earned money that I work for, and then it disappears out of my piggy bank faster than I put it in for some reason. I don't know.
That's weird.
Keeps taking it. But
yeah, somebody's robbing you. Right, exactly. That piggy, not trustworthy. Okay, so yes, that's the traditional job of a bank is to take deposits, loan out money, and then obviously pay some type of interest rate, depending on the type of account, and what exactly the structure of your relationship is with the bank. But let's talk about some of their basics. It says their primary role is to take in funds. That's your deposits. So that's when you take money to the bank, pool them, so put them together, and lend them to those who need funds. So banks are intermediaries between depositors and borrowers. The amount banks pay for deposits and the income they receive on their loans are called interest. So that's as you are depositing, your bank is hopefully giving you some type of interest rate, though for a long time interest rates were essentially zero. And depending, once again, on the type of account that you have, it's possible that you aren't really getting any interest from your funds at the bank. So that's something we're going to discuss just briefly. But
I've earned
depositors
a
can
few
be
pennies in my savings account.
exactly the tiny when you see the deposit amount, it says interest payment, and it's a rounding error. It's 5 cents. I found a nickel on the ground, guys. It's not. I don't need that
We'll
much.
give this to one of the customers randomly.
Yes, exactly. um, so yeah, that's the sad part of having kind of a traditional bank. But all right, deposits can be available on demand, like that's a checking account, or with some restrictions, savings, or there are time restricted deposit accounts, and we'll talk a little bit about that. So the banks loan out money. So at any given moment, some depositors need their money, but most do not. That enables banks to use shorter-term deposits to make longer-term loans. The process involves maturity transformation, converting short-term liabilities into long-term assets. So they're taking your money that you're giving them for an unspecified amount of time, but when they get a lot of it, they can generally trust that they can take some portion of that and loan it out to someone for, let's say, a mortgage, which is a long-term asset for the bank. That's over the course of general. What was that, Cameron?
It's like, or the bank invests it in for themselves and makes them more money.
Correct. Yes. And so they are making money, and sometimes they do it in kosher ways and sometimes ways that are a bit shady. And we'll get into a little bit about that.
And how many issues they've had.
Yeah, well, there's the Wells Fargo issues from, I think everyone heard about those a couple of years ago, at least everyone in the United States. Wells Fargo became famous for all kinds of issues with, I think it was mostly fees for them, wasn't it? Just like overdraft fees
and then forcing their managers to open up accounts and things like that, so they make more money off of. They've done a lot of shady things that they've got in trouble for. Yet
true.
they still seem to be running well for some reason.
Too big to fail, Cameron. Too big to fail.
That's right.
Yeah. So Wells Fargo still chugging along, very large bank in the United States, and has had some issues. So we'll talk a little bit about that, but so they have these long-term assets, these loans, and then banks pay depositors less than they receive from borrowers, and that difference accounts for the bulk of banks' income in most countries. So if they take a deposit in and tell you, okay, well, I'm going to give you for your savings account, I'll give you a 1% return, then they turn around, they take the money from my savings account and the 100 other people's savings account, they loan it out as a mortgage and say, okay, I'm going to charge you 5% for that mortgage. Well, if they're paying 1% to me and they're taking in 5% from the mortgage, then obviously they're making 4% just to line their pockets. So this is going to sound like a largely anti-bank podcast, but that's generally, I think, just the layman kind of frustration. They obviously serve a great role in the economy, a necessary role. But there are scenarios where we are the public interest is not served, and so that's some of the things that we're going to discuss, how that happens, and then why it sometimes leads to banking failures. All right.
I think we can go with that a little bit. They have changed from, I would say, over the last 100 years. Their roles.
Banks have?
Are we going to talk about digital? Like most everything is digital now. Hard currency is becoming less and less. So,
right. So we're going to talk about the fact that there used to be a gold standard, and then it was backed by silver, and then it's just nothing. And there's a term for that, and I guess we can hit that now. The term is fiat currency, and it is the case that that's relatively recent in the history of the United States banking system, that we are not backed by precious metals. So it says for the past 40 years or so, the U.S. has used a fiat money system, which establishes money through government action rather than backing the currency's value with precious metals. Because the government can now print money as needed without needing gold on hand, inflation is a greater risk. On the plus side, economists say that fiat money means the Fed can create currency as needed to help stave off recessions or avoid a repeat of the Great Depression. So that's kind of the idea. And then, like Cameron said, a lot of, nowadays, most of your interactions with your bank are online. You don't actually see a lot of the currency. The fact that the government makes it means it's not relevant whether or not there exists gold for this or some precious metal backing this number on your screen. It's just, this is how much I'm told that I have, or this is how much I borrowed or whatever, right? So that's the idea behind a fiat money system. And we've seen even recently in the United States history, the government essentially just printing money to stave off a recession. And that when the whole COVID pandemic hit and people were sitting at home, the government printed a lot of money and just gave it away. And that
and not just our government.
That's true.
Most of the governments around the world did that.
That is true. Yep. And so actually, that's one of the things that we'll also hit on a little bit more later. But the idea of an international banking system is relevant. And the fact that there isn't really an international banking standard, which is why you get all of these different issues between different and how currencies change in their relation, the value of the United States dollar versus the euro. Those types of things are related to how the economy is going in particular areas, but also how the monetary policy is affecting the currency of that government. So, but let's go back a little bit here briefly just to discuss once again just kind of what the basic of a bank is before we hit more of these kind of more economic policies that affect banks. This says a bank's most important role may be matching up creditors and borrowers. The banks are also essential to the domestic and international payments system, and they create money. Not only do individuals, businesses, and governments need somewhere to deposit and borrow money, they need to move funds around. For example, from buyers to sellers, or employers to employees, or taxpayers to governments. Here, too, banks play a central role. They process payments from the tiniest of personal checks to large value electronic payments between banks. So this is kind of what I was talking about. This is, there are things that your bank does that you probably don't even think about frequently that are, crucial to the working of the economy. And so while it's easy to focus on, the fact that you got this massive overdraft fee when you're pretty sure it was the bank's fault, that's super frustrating. And maybe it was the bank's fault. But it is the case that they are also doing a bunch of other things that are making your life significantly easier. Just in my lifetime, the fact that we used to have to carry around coin purses or whatever, like coins to me are they're relics of the past. They're collector's items. My little girls still collect pennies or whatever, and they hand it to me, and I was like, well, if you don't want it, I'm throwing it in the garbage. I don't need a penny. I don't want a penny. I don't really want a nickel. Maybe at the point of dime is when I start saying, well, maybe I shouldn't throw this in the trash. But generally, I just don't even see it anymore. Coins are kind of a thing of the past, and is by and large cash, right, Cameron?
Yeah. I would, with your little girl, with the penny, it does cost the U.S. more money to make the penny than the penny is actually worth.
It's true.
And so maybe we should get rid of it.
I think there is discussion about doing that. So I hope that they do. They
have eliminated the penny on all military bases, from what I've heard.
There you go. I've heard, and this is taking on a slight tangent from our banking discussion here, but relevant kind of, that there are areas in China that have gone completely cashless. Meaning you cannot pay for it with cash at a particular business or any businesses in that area, that city. I'm not sure. I don't know the specifics of it, but that cash is not accepted. You have to use some type of electronic means of paying, credit card, debit card, whatever else they have available, Apple Pay or whatever it is. Have you heard about anything like that, Cameron?
My current work will not accept any cash.
Right. You're starting to see that more, right?
Mm-hmm.
Yeah. And you also see, just that it's, candidly, when I see someone pull cash out and I'm standing in the grocery line at the grocery store, I'm slightly frustrated because I think I should have picked a different line, because instead of tapping and going, now it's like, okay, well, I've got to make change and count it and all the other stuff. So it's kind of become a nuisance. And there are scenarios where cash is still needed. I still use it on occasion, but it's becoming less and less the case that cash is something that you interact with on a day-to-day basis. But like Cameron said, a lot of this is just digital now, right? So, but let's talk a little bit about how
you still need to give that, money, that piece of whatever you want to call it, currency, in your birthday envelope to your children or something like that. It's that physical.
That's true. Yep.
I mean, I know they do make them now where you can just put your prepaid debit card in the gift card, but it's just not quite the same. You know what I mean?
Yeah, exactly. Have you ever just held a wad of cash before? It kind of gives you this power trip, and it's hard to simulate that holding a debit card. It's just not the same. It's like, it could mean it's worth a lot more, but it's just not as fun as just making it rain.
Stick card with $1,000 on it, or would you rather have 1,000 ones in your hand?
1,001 seems a bit excessive.
But then you can put it in the little money shooty thing, and be like, ooh, I don't know.
Is money shooty thing? Is that a term that I need to be from? I'm not even sure what you're talking about.
It's like a little gun they use in music videos that shoot out usually hundreds, and showing that they're how affluent they are.
Okay.
They're
all right.
Money into the air for fun.
That sounds like fun.
I'm not that affluent, so I would just fill it full of ones.
Yeah, exactly. All right. Well, all right. Let's go back to. It says in many cases, payments are processed nearly instantaneously. So going back to the way that the banks function and the kind of some of the things that they do, so that the payments are now just instantaneous. Payment system also includes credit and debit cards. A well-operating payment system is a prerequisite for an efficiently performing economy. And breakdowns in the payment system are likely to disrupt trade and therefore economic growth. So banks create money. So they do this because they must hold on reserve and not lend out some portion of their deposits, either in cash or in securities that can be quickly converted to cash. The amount of these reserves depends on the bank's assessment of its depositors' need for cash and on the requirements of bank regulators. We're going to talk about regulation here in a little bit.
Didn't that come around from the Great Depression?
I think so.
That required banks to hold on a certain portion in case if there ever was run on the bank again.
Yeah, there have been a couple of banking laws passed in the United States that we're going to discuss in detail, or not super detail because this is learning from a layman, but kind of the general fallout from the particular financial crisis and how it became law and what that law did. So yes, I believe that's the case, but we'll hit that in a second. So they do need to hold some on reserve, and the amount is also something we'll discuss. So typically, the central bank, a government institution that is the center of the country's monetary and banking system, determines these requirements for deposits, the amount that the bank needs to have on hold in reserve. Banks keep these required reserves on deposit with central banks such as the U.S. Federal Reserve, the Bank of Japan, European Central Bank. Banks create money when they lend the rest of the money depositors give them. This money can be used to purchase goods and services and can find its way back into the banking system as a deposit in another bank, which is kind of a weird way of thinking about what happened to your money. You see it in your bank, when you log into your online banking system, but in reality, somebody just used that to buy a new car, and that money that you deposited into the bank, while you can get it back, is currently in use somewhere in the economy. So, this process of relending can repeat itself a number of times in a phenomenon called the multiplier effect. The size of the multiplier, the amount of money created from an initial deposit, depends on the amount of money banks must keep on reserve. So that's what the federal bank, at least in the case of the United States, the Fed kind of has to consider when making these policies, and the government, when they're passing these laws, is if banks need to have a large percentage of the reserves, of the deposits on reserve, then that money can't be going back into the economy to kind of create this kind of self-perpetuating system of this multiplier effect that they're talking about. And so let's talk a little bit about securities and bonds. So it says banks can complement traditional deposits as a source of funding by directly borrowing in the money in capital markets. They can issue securities such as commercial paper or bonds, and they can temporarily lend securities they already own to further institutions for cash. A transaction often called a repurchase agreement. So this is something way over the head of me when I started reading about this stuff. I was like, I've heard the term bond and security before, but to be entirely frank, I didn't know what they were. So let's give the definition for the layman here. A security is, in a financial context, is a certificate or other financial instrument that has monetary value and can be traded. Securities are generally classified as either equity securities, such as stocks and debt, or as bonds and debentures. I don't even know what that word is. So let's just move right on past it. Bonds. So once again, something I've heard about before, maybe even something I own, though I'm not entirely sure, are investment securities where an investor lends money to a company or a government for a set period of time in exchange for regular interest payments. So once the bond reaches maturity, the bond issuer returns the investor's money. The fixed income is a term often used to describe bonds, since your investment earns fixed payments over the life of the bond. So that's a security and a bond. Securities are a broader term that include bonds, and bonds are specific types of securities that are set for a set period of time. So government bonds are a big thing. And that actually bonds played a role in the banking failure of Silicon Valley Bank, which we will wrap up by talking a little bit about, once again, just how that happened and how you can protect yourself, if you can protect yourself in the future from that type of issue. Cameron, any questions about securities or bonds?
Just makes me think of Moneyball. Not Moneyball.
The not baseball?
Moneyball. The Big Short. The Big Short. That's the movie.
Oh, The Big Short. Okay. I was trying to come up with how baseball factored into securities and deposits.
No, the Big Short, where basically it showed me that, man, is our banking system corrupt, and I should not trust banks.
Just the way that there's this saying, like, absolute power corrupts absolutely. It seems like the access to unlimited amount of money also corrupts. So there are scenarios where it just seems.
And then I guess, since you're able to make your own money.
Yeah. Right. Yeah. Well, it's problematic. So we're going to move on to regulation here in just a second. So let's see. Before we do that, let's talk a little bit about monetary policy, because what's more exciting than monetary policy?
I know. Polytary policy.
Okay. All right.
Mono is one, poly many.
Okay.
Anyway.
Yep.
Okay. I'm sorry. That's my dad joke for the day.
Oh, we always need one. Okay. Monetary policy. Banks also play a central role. Going back to that. That reminds me of the Victor Borge, the inflationary language. bit. If our listeners had never heard Victor Borge before, he was a comedian pianist. I think he passed away, I don't know, quite a while ago, 20 years ago. I'm not sure, 30. And he had a bit that he did where inflationary language, where every number that you said, and not even just numbers, but any part of word that was a number, so instead of wonderful, it would be tutorful. And he did a whole story. Anyway,
Lieutenant would be Lieutenant.
Exactly. So it was a good time. Okay, back to monetary policy. Banks also play a central role in the transmission of monetary policy, one of the government's most important tools for achieving economic growth without inflation. The central bank controls the money supply at the national level, while banks facilitate the flow of money in the banks within which they operate. At the national level, central banks can shrink or expand money supply by raising or lowering banks' reserve requirements. So that's what I was talking about earlier. This is one of the things that the Fed considers. And by buying and selling securities on the open market with banks as key counterparties in the transaction, so the Fed can actually step in and buy and sell securities, which can have effect on the monetary policy. Banks can shrink the money supply by putting away more deposits as reserves at the central bank, or by increasing their holdings in other forms of liquid assets, those that can be easily converted to cash with little impact on their price. A sharp increase in bank reserves or liquid assets for any reason can lead to a credit crunch. So if you've heard that term credit crunch before, this is it's when the bank's reserves are increasing, or their purchasing of liquid assets all of a sudden is their credit, the amount of easy money there is in the system is shrinking. So by reducing the amount of money banks have to lend, which can then lead to higher borrowing costs as customers pay more for scarcer bank funds. So that's a little bit about how the banks deal with monetary policy. So, and then three ways that banks can or the three vulnerabilities that banks have: higher proportion of short-term funding, such as checking accounts and repos, to total deposits. Most deposits are used to finance longer-term loans, which are hard to convert into cash quickly. So that's the scenario where you've got, and that my understanding is that was related to how the Silicon Valley Bank went under. So once again, I'll hit that here right at the end. But a low ratio of cash to assets, and then a low ratio of capital, assets minus liabilities, to assets. So the layman in me kind of isn't entirely clear on how those last two are different. I mean, that's why it says assets minus liabilities. But anyway, just so we're aware, the banks have these vulnerabilities. What, Cameron?
If you're an accountant, you understand.
Okay, and I'm not.
So it was liabilities and capital. Was that what it is?
The low ratio of capital to assets.
Oh, capital and assets. So capital.
It says assets minus liabilities. That's what it says for capital.
Yeah.
So
so your assets is basically easily available cash, versus your debt.
Well, this says. Hold on. This says
other stuff.
Well, I think the idea is that if you own a bunch of mortgages, if a bank owns, let's say, 100,000 mortgages.
Yeah, because it's our capital, and
those are
always buildings and land, everything like that goes towards your capital.
Right. So those are assets. But if I have 100,000 mortgages, but only a small amount of cash, I don't know what a small amount of cash is for a bank. Let's say $1 million. I'm in trouble because I own 100,000 mortgages, which is, probably $1 billion, or I have no idea. A lot of money there, right? Whereas, and I have $1 million in cash assets or in cash, then I could, I'm liable to have a bank run because I don't have the money to give to depositors when they need it, because I have all of my money sunk into assets. That's my layman understanding. And then capital, assets minus liabilities. So I've got a bunch of mortgages that I own, but then I also have my own liability, meaning like I've borrowed money from other institutions. I've got some of my money leveraged in some way that the bank is paying interest to someone else. And so I've got that's taking away from my income from these other assets that I do own.
Till you've reached, But anyway, it gets really complicated. Take an accounting class, or
don't, or listen to this podcast.
Wikipedia a little bit. What we're also talking about, if you're unclear, and you'll probably get more confused because, goodness, it's confusing.
Right, exactly. Let's hit 2 or 3 more points before we start diving into regulation. Which, once again, these are like so exciting to almost nobody, but useful to know for the layman, and like I said, anecdotally useful, hopefully enough to continue listening to the podcast, because when we talk about it here at the end, the run that happened on the Silicon Valley Bank, you can start understanding how this could happen elsewhere and how it might affect you. So let's talk about regulations. Regulations are generally designed to limit banks' exposures to credit, market and liquidity risks, and to overall solvency risk. And so the bank safety and soundness are a major public policy concern, and government policies have been designed to limit bank failures and the panic that they can ignite. So again, if you've been in the United States in the last week, that's been a huge piece of conversation, right? Just the bank that failed, even if it wasn't as relevant to you as it turned out to be to me, is that when a massive bank, the second largest bank in the history of the United States, failed, so not the second largest bank in the history of the United States, the second largest failure of a bank in the history of the United States, that becomes obviously a big concern. All of a sudden, everyone is looking at their bank with a little less certainty. So that's regulation. So let's talk a little bit about how that's regulated. We've already talked a little bit about the Fed. I'm going to dive into that even more. But it says the Fed is what determines that banks must retain at least 10% of each deposit on hand and can lend out the other 90%, at least 10%. So that's the Fed can actually change that number or lower. I don't think it actually can go lower, but it can be significantly higher than 10%. I can drop all the way down to 10% as determined by federal law. So that actual reserve requirement is determined by the Federal Reserve Board of Governors. When the Fed reduces the reserve requirement for member banks, it is implementing an expansionary monetary policy. We were just talking about the idea that we want more money out there in the system being borrowed and used, and so when it's increases that money that needs to be on hand, it is implementing a contractionary monetary policy, and that makes it that credit crunch that we were talking about. The FDIC, which is the Federal Deposit Insurance Corporation, it's an independent agency created by Congress. It was created to make sure that when banks have issues, that people can get their money still, right? So part of the U.S. history currency was the gold standard. We already talked about that, right? And so we now have got this fractional reserve banking idea, the idea that only a certain amount of it needs to actually exist in the bank. And so the FDIC was formed to prevent such occurrences by ensuring all deposits that customers keep at the bank. So it ensures savings accounts, checking accounts, and other deposit accounts. During the 2008 global financial crisis, the FDIC raised the deposit limit to $250,000 that is being insured. And when the Silicon Valley Bank failed, most individuals out there, the layman out there, probably doesn't have a lot of accounts over $250,000. That's really not relevant to most of us, right? But as a corporation, $250,000 is it's a pretty insignificant amount of money when you think about it in the terms of a business. And so that's why it became such a the idea that the Silicon Valley Bank was largely a corporate bank that had a lot of big, it helped a lot of startups. It was a bank for lots of obviously companies in the Silicon Valley area um, that probably had millions of dollars on the book, and $250,000 wasn't going to cut it, which is why on Sunday, President Biden said, actually, we're going to insure everything. And we'll talk a little bit about why that is a bit problematic, and even if it makes sense. Okay, so I said the word commercial bank. There are different types of banks. There's commercial banks, which they provide various services such as providing business loans, accepting deposits, and offering basic investment products to individuals and private businesses. Commercial banks also offer other financial services such as global trade services, merchant services, insurance products, retirement products, and treasury services. There's credit unions. That's one that the layman might be pretty familiar with. Credit unions type of bank that's your local neighborhood bank type. Open to a specific category of people who are eligible for membership. Member owned, so you have stock in your credit union, right? And it's operated by the members on a basis of people helping people, right? So the idea is that this is a community-serving institution, non-profit, just there to do the functions of a bank, but without the overhead of most of these big banks. So there are benefits to that, right? You get a higher interest rate generally in a savings account or whatever, lower interest rate on the loan, but the downside is it's local. It's generally, there are a couple branches of your local credit union, maybe a few in your state, but not outside of that. And so when you start talking about interacting with other banks, going out and using the ATM in a different country or whatever it is, things get a little trickier. Your credit union's having to use services from a larger bank, which then they are getting charged for. So I said there are things to consider as far as credit unions, but they're a nice local way to use a bank. And then there are investment banks. Investment banks are banks that provide corporate clients access to the capital markets to raise funds for expansion. They help companies raise funds in the stock market and bond market to finance their expansion, acquisitions, and other financial plans. They also facilitate mergers and acquisitions by identifying viable companies for acquisition that meet the buyer's criteria. So my understanding is these generally rigid kind of definition of what a particular bank is kind of is fuzzy these days. And there's also online banks, and that's obviously very, very recent that there are. All right, one I'm familiar with is the Discover Bank. Like Discover card is a well-known credit card in the United States. I don't think it's as big outside of the United States, but they've started their own bank. It is a fully online bank, meaning there is no branch. There is no brick and mortar store out there. You can't go talk to a Discover Bank employee person face to face. That doesn't exist. So because of that, they have some of the they can offer higher interest rates. They have relatively lower fees because they just don't have the overhead that a brick and mortar store. A brick and mortar bank is going to cause. Anyway, but these distinctions between an online bank, an investment bank, a commercial bank, my understanding is they're kind of fuzzy these days because of some of this regulation, which we're now going to dive into changing and the way that that affects how banks have to operate. Cameron,
I was actually going to say, I actually use an internet bank.
Oh, you do?
Uh-huh.
And what is your opinion?
A local brick and mortar bank that we use, and then I have an internet bank. And I have found that internet banks don't always work nicely with things. Same with some of my local credit unions. Like if I'm trying to link like a PayPal account or something like that, if they don't like each other, they will not allow you to link anything, which has been frustrating at times.
Right. Yeah, that's one of the things that you get right from these huge banks is that they're integrated into everything, And so you get the benefit of that, where the local credit union or a newer online bank probably doesn't have that same access. But you're at least getting good interest rates, right, Cameron?
Yeah. And my my online bank has no fees, so I don't get hit with any overdraft fees or anything like that. Granted, they don't let you spend more than what you have.
Well, that's to be expected.
Yes, but there's no overdraft fees. There's no fees with that bank.
That's nice.
Which I really like. I was like,
yeah, that is good.
I like that. That's great.
Right.
So.
Okay. Awesome. Well. Okay. So I was going to talk a little bit about the basics of accounts. I assume that most laymen know what a savings account is and a checking account. So I'm not going to dive into that really. A CD, or a certificate of deposit. That's a fixed amount of money for a defined period of time, and so you're getting a particular interest rate for a certain amount of time. Most people are familiar with those as well. Whether or not you've ever had one, maybe you probably heard of them before. Anyway, those are some of the different types of accounts. Then there's a money market account that banks offer, and that's going to have a minimum balance, but that's going to give you a higher interest rate because the money is less accessible. I don't think I'd have a money market account, but the idea is that you can't just pull it at the drop of a hat because it's invested in like the stock market or something like that, some type of security out there that you're actually invested in, instead of them doing it quietly behind your back and them keeping the money. A money market account gives you more of that return of your own money, but then requires that when you want your money back, they have to have more time to give it to you. So anyway, let's talk regulations.
Way for them to use your money to make themselves more money.
That's what banks do. Okay, so let's talk regulations. This is where we're really diving into history class. Probably, Cameron, you've heard about the Glass-Steagall Act before, maybe in the history class at some point.
Unfortunately, I do not remember learning that. It's quite possible that I did. I just do not remember.
Okay. That's okay. Even if you did, if before I did the research for this podcast, you'd ask me what the Glass-Steagall Act was, I could probably tell you it was a banking act, and that's where my knowledge would have ended. So let's give you, the layman, a little bit more information about why that's relevant, why the Glass-Steagall Act is relevant right now, and how it's transformed and changed over the course of the last 90 years. So it was enacted in 1933. And if you're familiar with our history series, which we kind of died at after I think we finished in the 30s. Anyway, that's the time of the Great Depression, right? So this is the Glass-Steagall Act. Following the stock market crash, commercial banks were accused of having too much speculative and taking too much risk with depositors' funds. At the time, commercial banks were heavily engaged in stock market trading, and they used their depositors' funds in these ventures. So when the stock market crashed, many banks were unable to return depositors' funds in full. Many depositors rushed to withdraw their savings while banks still had funds, leading to bank runs that created a domino effect on bank collapses. So the bank run that you see in It's a Wonderful Life, that's the idea of, people, everyone hears, this bank's not going to be able to have doesn't have enough money for everyone to get their money out. I want to get my money out right now then, before everyone else tries. So that's a bank run. So when the stock market crash happened, that's what happened to a lot of these banks, and so the Glass-Steagall Act started being formed. So Glass and Steagall were senators. I think we'll hit that here in a second, but congressmen in the United States federal government. This was enacted to resolve, and they came up with this act, which was enacted to solve problems allegedly caused by commercial banks. There was a shared view that banking industry had become greedy, investing in risky portfolios using their depositors' funds. one of the changes created by the act was the separation of commercial banks and investment banking activities. So they created this distinction that I said is a little fuzzy now because some of these things have been repealed or changed in the last 90 years. Banks were given a year to choose if they wanted to be a commercial bank or an investment bank. The law also formed the Federal Deposit Insurance Corporation, which we already talked about, which is the FDIC, which when you go to your local bank and you see that on your, a stamp somewhere, that's what that means, that your funds are guaranteed. When it was first the Glass-Steagall Act was first passed at 1933, the FDIC insured deposits up to $2,500. So that was that's not a lot. Obviously, back then it was a lot more. So this was increased to 5,000 when the agency became permanent 2 years later, and then obviously, like I said, it's now all the way up to 250,000 as of 2019. And or 2023, which is now, who knows, maybe the limit will increase again because it was all funds were just insured for the latest bank collapse. The FDIC was given the authority to insure banks under the Federal Reserve System and act as a regulator of banks chartered by state governments, but not under the Federal Reserve System. So in 1965, the Congress passed the Bank Holding Company Act as an extension of the Glass-Steagall Act to tighten regulations on the banking sector. The new law targeted banks involved in underwriting insurance, which was considered too risky. The decision to prevent large banks from amassing too much power to the disadvantage of consumers. So this is, I guess, when you're talking about regulation, this is really comes down to, for a layman, it's this interplay of, are banks getting too greedy, so we need to regulate them, or does regulation hamper them to the point that the economy is not doing as well as it could? And so that's this interplay between, do we need to regulate it, or do we need to slash regulation so the banks can kind of just go hog wild and use money in any which way they want, which can have disastrous outcomes. But until it has disastrous outcomes, means everyone gets to reap the benefits, not only the rich people that in the banks, but the consumers of the bank services get to reap the benefits of, they're paying me 10% to deposit my money. Great, until they're paying nothing because they're gone, right? So that's what this regulation is about. And the Glass-Steagall Act took this step because we had the Great Depression, which is obviously was going to precipitate some type of action from the government when you have such a catastrophic outcome in the economy. So, however, this push and pull between the bank owners and employees, the bank lobby essentially, versus regulation from the government, came to the point where the Glass-Steagall Act was repealed. It says large U.S. banks were commercially disadvantaged compared to foreign banks that performed both commercial and investment banking activities. So that's, like I said, one of the problems with regulation, and I kind of alluded to this near the beginning of the podcast, is that we don't really have a full international banking monetary system, right? It's per government, per country. And so if we are tightly regulating our banks here in the United States, but a international bank has significantly looser restrictions, then all of a sudden you have rich people offshoring their money, right? I'm going to deposit my money elsewhere because the banks can offer me better interest rates, better whatever. And so if my local bank, United States banks, are not performing as well as international banks, then all of a sudden the government's incentivized to be able to give them a leg up, because obviously your bank is going to be paying taxes, and so and just generally driving your economic growth. And so if you are regulating them too much versus foreign banks, you are probably hindering your economy to some degree. Cameron, did you have an insight, and maybe you offshore your money?
I don't offshore my money. But that is an interesting thing. But that's why probably lots of criminals offshore their money to certain areas. Here, particularly in the U.S., they go to the Caymans, is always talked about, probably because they have very loose regulations there to where people can't get their money.
And candidly, I didn't spend a lot of time doing criminal investigation into why people take their money outside of the United States. I do. I am a.
That fact.
Yeah. I mean, yeah, exactly. Clearly there are reasons that people take their money elsewhere. Switzerland, for example, right? Matt's joined us also, I believe. So.
Yes, the Nazis hid lots of money at Switzerland, but they don't want you to know that.
Yeah. So lots of different banks that would be, like I said, international banks. And when you're uber wealthy, maybe it makes sense and maybe you have someone that does this. You have a guy that does the bank research for you and figures out where to put it. For the layman among us, this is kind of irrelevant, except in the way that it affects the overall economy, once again. So back to the idea that now we're repealing the Glass-Steagall Act. As a result, bankers and most regulators agreed that some of the things that the act aimed to guard were ambiguous and started working on ways to overturn the act in the 1980s. In 1999, Congress passed the Graham-Leach-Bliley Act. That act overturned the Glass-Steagall Act and allowed banks to offer commercial and investment banking services. So there were some restrictions there, obviously always some regulation at the federal level, but essentially it rolled back a bunch of the regulations. And that was during President Clinton. It said the new law encouraged the growth of large banks in the United States, including Citigroup, Bank of America, and JP Morgan. The act allowed commercial banks to provide insurance underwriting that was previously restricted. And then obviously there was fallout from that. Followed was aggressive risk taking by banks, reap profits from securities trading. So all of a sudden we now have the same issues that we had before. And lo and behold, less than 10 years later, we get a financial crisis again. Now, it's hard to directly track any one action in a massive economy to a particular law, but obviously there were multiple things contributing to the financial crisis of 2008, 2009, but it was the case, obviously, this probably had some effect on it. It says after the financial crisis, some legislators wanted to reinstate the Glass-Steagall Act. Key players in the financial industry didn't, obviously, want that because it was going to hamper them. Instead, legislators passed the Dodd-Frank Act in 2010 that made efforts to reinstate sections of the Glass-Steagall Act through the Volcker Rule. And so we're getting a bunch of different things here. I guess we could probably hit here the Dodd-Frank Act. It says it's a Wall Street Reform Bill. The Consumer Protection Act of 2010 was enacted into law during the Obama administration as a response to the financial crisis 2008. Named after Senator Christopher Dodd and Representative Barney Frank. It sought to introduce significant changes to financial regulation and create new government agencies tasked with implementing the various clauses in the law. So once again, just the whole idea is to create some financial stability, regulation to prevent another crisis like we just had in 2008, 2009. And so it established the Financial Stability Oversight Council, FSOC, to address issues affecting the financial industry and protect consumers from abusive financial practices. So that's the Dodd-Frank, and that right now that's in the news, right? Because the Dodd-Frank was repealed. Well, let's get to that. But right after I mentioned the Volcker Rule, another key provision in the Dodd-Frank Act is the Volcker Rule, which prohibits banks from making high-risk speculative investments that may disadvantage their customers. And so that's the idea behind the Volcker Rule is, once again, we don't want these high-risk speculative investments that cause these financial crises to happen. But then, once again, with the idea of this push and pull of regulation versus growth in the economy, Dodd-Frank was repealed, at least parts of it. And I'm trying to find the year for that. Oh, yeah, there it is. In 2018, the U.S. government created the Economic Growth, Regulatory Relief, and Consumer Protection Act, exempting dozens of U.S. banks from the Dodd-Frank Act's banking regulations. And so that's a massive acronym. That doesn't really roll off the tongue, does it? That one is the one that is currently in. And so the idea there is that the law raised the asset threshold at which banks are subject to stricter regulations from 50 billion to 250 billion. So smaller banks didn't have to have the same regulations under the Dodd-Frank Act. And so coincidentally or not coincidentally, the Silicon Valley Bank had just under $250 billion when it failed. So the idea that these banks had less regulation makes it easier for them to grow, but also makes them more likely to fail. So that's a little bit about the regulation and why we regulate. Says the Dodd-Frank was enacted with the aim of preventing a recurrence of the financial crisis that almost crippled the United States financial system. So do we want that regulation? I don't know. From the layman point of view, you want some, right? It's just how much and what makes sense and how do we hold our banking systems accountable. Let's hit two other points before we finish up with talking about the failure of the bank and how the layman can protect ourselves. Before we talk about a couple other terms, I wanted to just mention once again, we have listeners in all 50 states, but we are really not doing well in northern Canada. Yukon Territory still shutting us out. So if we could just get a few of you northern Canadians that do listen to just pass the word along, carrier pigeon, dog sled, whatever you need to do to get the word of the Learn It From a Layman podcast up to those remote tribes and villages in the north. Let them know that they can listen to a banking podcast or any of the other podcasts that they like. And go ahead and share that with them. Probably not carrier pigeon, though, because I think they're all dead. Can I get confirmation, Cameron, or that we have? Do you have a carrier pigeon? Is that still a thing?
They are all dead, but there is a few genetic scientists working on bringing them back. In a very interesting way. Maybe we'll use that in another podcast, but they may come back at some point.
That's just like the woolly mammoth. I've heard discussions about bringing the woolly mammoth back, which would be pretty cool.
I would like to see a furry elephant, so that'd be cool.
That would be quite interesting. I've heard that it could have some benefits to the climate. I don't know. Anyway, mostly I want to pet a furry elephant. Can we get that to happen? Okay, back to banking. So a couple of these terms that the layman hears that all over the place, and that I, as a layman, was unfamiliar with exactly how that worked, and I wanted to just give a little insight to that. So quantitative easing. This was all the rage here, I think, a couple years ago. You heard it all over the place in like economic reports or whatever. Quantitative easing is a monetary policy for printing money that is implemented by the central bank to energize the economy. The central bank creates money to buy government securities from the market in order to lower interest rates and increase the money supply. So essentially just shoving money into the system. And when is it used? The government's economy is stagnant or not performing well. Quantitative easing can be used by the central bank. Will evaluate the causes or factors that affect the status quo and then take measures to ease the issue. So usually higher interest rates and inflation are the major factors that trigger the economic slump, especially when they're getting out of hand. So to carry out this unconventional monetary policy, the central bank will buy government securities from commercial banks and other private financial institutions. It will lower short-term interest rates that the prices of these financial assets will raise, boosting investments. Essentially, it's a way of consuming these bonds, these government-backed bonds, by using government-printed money. And that just puts more money in the system. And there are probably downsides. It says there are negative effects of quantitative easing that will typically only be felt in the future. Of course, that's how a financial system works. Increasing the money supply too quickly will cause inflation. So, and we could talk a little bit more about quantitative easing, but I think just a basic understanding of that's what they're doing. They're buying these government-backed securities with this money that they're printing, and it just lubricates the system. And we now have money flowing, but the problem is when you get a bunch of money flowing in the system, everyone's got more money, right? And that is called inflation. So, and what do we do about that? Well, how about hiking the interest rate? And so that's the Fed hikes the interest rate. And by the way, we talked a little bit about the Fed. That's the central bank of the United States. It says the Federal Reserve, more commonly referred to as the Fed, is the central bank of the United States and is the supreme financial authority behind the world's largest free market economy. Because of the magnitude of the U.S. influence of the global economy, the Fed is considered one of the most influential financial institutions in the world. And we could talk about the Fed for a long time, but we're not going to. So back to hiking interest rates. It says a hike in the Fed funds rate is one of the key monetary policies levers that the central bank has in its arsenal to slow down inflation by making it more expensive to borrow. This in turn can also apply the brakes to an overheating economy. Generally, rate hikes mean that the economy is approaching the peak of an economic cycle. So as it's raising the interest rates, it's harder to get money, right? That's once again takes you kind of a credit crunch idea. Higher interest rates lower inflation by making it more expensive to borrow, decreasing the money supply, strengthening the dollar, and managing market expectations. So that's the case right now, right? Where the federal bank keeps raising interest rates, which is why we got mortgage rates out there at 6.5%, 7%, which historically is actually still not too bad, but compared to those out there that were buying 4 years ago that got, or 3 years ago even, that got 2.99% interest rates or whatever, it hurts when you're trying to buy a home. So those are a couple of the terms that I had cursorily familiar with before, and I wanted the layman to also become a little bit more familiar with. Okay, let's wrap up here with talking a little bit more about what happened to the Silicon Valley Bank and what might happen in the future and how you can essentially protect yourself. So I grabbed this from a news article. It said all banks face interest rate risk today on some of their holdings because of the Fed's rate hiking campaign. This has resulted in $620 billion in unrealized losses on bank balance sheets as of December 2022. So that's essentially the Silicon Valley Bank had a lot of these securities they had purchased for that at lower interest rates, and so these are long-term assets, but pay at a particular rate, and you can trade these. But when the interest rate at which you purchase these securities is now significantly lower than the rate that the government is currently issuing them at, you can't trade them. All of a sudden, that's you're going to get whatever that interest rate is until the maturity of that loan or of that bond. And so, if you need funds quickly, well, you can't get it. Previously, you could trade that for some other asset or cash that someone else would buy your bonds off of you or whatever. Well, they're not going to buy a bond that's paying at 2% when they could get one from the government for 5% or whatever. So all of a sudden, you have a liquidity crisis, which is essentially what Silicon Valley Bank faced, and that is part of the issue. Like I said, you're learning this from a layman. There are lots of news articles out there, but the general idea is that the SVB, Silicon Valley Bank, and Signature, which is another one that was, I don't remember if it's completely failed or if it mostly failed, were complying with regulatory requirements, but the composition of their assets was not in line with industry averages. So Signature had 5% of its assets in cash, and SVB had 7%. So it did not have enough cash on hand. That's what it comes down to. So the industry average is 13%. So they had, half or less than half of the industry average of cash available. SVB, Silicon Valley Bank, 55% of their assets were in fixed income securities, like what I was just talking about, compared to the industry average of 24%. So that's kind of where they really got themselves into a corner. And then, as the government's decision to backstop all deposits of SVB and Signature, regardless of their size, make it less likely that banks with less cash and more securities on their books will face a liquidity shortfall because of massive withdrawals driven by sudden panic. So that's the argument to do what the government did, is that all of a sudden you just don't have that panic in the same way. It's like, oh, the government's going to handle it. The flip side of that coin, right, is the concern that if the government's going to handle it, then the banks don't feel a need to be accountable, and they can just go out and do things willy-nilly as long as they're not going to get caught. Even if they fail, then everyone's going to be bailed out. So the consumer's interest is entirely in finding a bank that will give them the best deal that they can get, regardless of how the bank is doing that, right? Because everything that I, as a consumer, deposit into the bank is going to be covered. So I don't have any incentive to watch out for shady investments or shady practices from the bank. So that gives the company no incentive to also, self-regulate in that way, beyond just the basic requirements of the law. So that's why this step of ensuring the whole deposits for everyone is going to come with some downsides. Is, once again, we're providing no incentive to the consumer to investigate banks. But as a layman, when I heard this reasoning, I'm like, well, I never investigate banks. Why would I investigate banks? I have no time for this. I investigate banks to the point of, can I give you my money and get a debit card and a credit card or whatever and get some money back? Thank you. Okay. Very transactional in basis in how I interact. Cameron, I'm assuming you as a layman also pretty transactional with your bank, not a lot of deep research into how they function.
No, but I've always wanted to start my own bank, and it seems like that's not a bad idea, because if I do that, then I can get lots of money, and then it can magically go to some international bank. And then I just failed, and then the government bails out all my customers, and I'm still doing well.
Right. Yeah. So the people at the bank, yeah, I mean, it becomes tricky, and then it's like,
it just seems like, I don't know. Maybe we should just have a government-run bank, but that also seems not like a good idea. There's lots of weird, things going through my head right now.
Yes, I'd love to invest in your bank, Cameron.
Sweet. You can be the CFO.
All right.
Bank.
Clearly, I'm qualified by giving this podcast.
Yes.
Yes. So essentially, the investors in the bank are the ones that have to be careful now, because you invest in a bank that fails, you are not getting bailed out. Your share of Silicon Valley Bank is now worth the dirt in your front yard. I mean, it is trash, because that bank actually went under, right? The people working for that bank no longer employed, or at least won't be after a certain amount of time. The government takes it over, and some of the people I know actually used to work for, or currently work. I don't know. It's kind of weird, for the Silicon Valley Bank. And they said there's some type of 45-day period at which the government was going to employ them to help get through this first step of bank failure. Job? No, more like to make sure the assets and deposits and all the things that the customers need to get access to happen.
Okay. So
essentially a winding down period.
Money in the bank can get their money, and then the bank dissolves, and then they're jobless.
Yes, that's essentially my understanding. So
that really makes me want to perform well for that 45 days.
I guess I heard, this is rumor, but that they get paid time and a half for those 45 days. So
there we go. I'm going to get paid well no matter what I do. So all right.
Yeah, and then they'll go move on to a new bank and hopefully not do the same thing. Yeah, so that's it becomes a bit self-perpetuating, at least in the incentive structure. And even if the investors have some incentive in making sure the bank's not doing shady things, if the consumers are not interested in good regulatory practices, and good sound fiscal policy by the bank, then at some point you're going to probably run up against another financial crisis, at least to some degree. So anyway, that's the layman needs to consider a few things when looking at your bank. You need to consider interest rates that you can be getting, right? Be that on a loan or on your deposits. You need to be considering how long it's been a business. You need to consider, the footprint of that bank. Is it a local? And if it's a local bank, is it well liked and well recognized by the community? Are they, doing a good job out there? Or is it like at a national bank, Wells Fargo, Citibank, or whatever, that is so large that that the government will make sure that it doesn't fail? So there are some things that the layman, just basic things to consider when looking at a bank. And like Cameron said, there's fees to consider, all of those types of things. But if I'm to add one more thing to the layman's job plate, is just consider the likelihood that your bank is doing shady things, and or the likelihood that it's going to fail, because that, while it seems unlikely, right? The last line of the last article I read before we started this says, however, with over 1 trillion of bank deposits currently uninsured, I believe that the banking crisis is far from over. So that coming from somebody obviously that has some knowledge of the banking system. So just be aware of where your money is at. Maybe diversify. That would be a good idea.
So basically what we're saying is most banks are doing shady stuff, and that we should just keep all our money under that $250,000. Just
Right.
rent it that long. So it is insured by the government, so we can get it.
Well, that's one way of doing it. The other way would be shoving it under your mattress, like we started the podcast, right? Or the piggy bank that is self-emptying. Anyway,
yeah, I really need to talk to Doc about that. I think she's stealing my money.
Talk to who?
My dog Wrigley. I think she's stealing my money.
Okay, that seems likely. It would probably be coming out on the other side if that were the case.
I don't know. She's pretty clever, even though she doesn't have opposable thumbs. She's able to do a lot more stuff with her paws than I would have expected. So.
Okay. All right. Well, then don't use your dog as a bank, guys. And if you use a piggy bank, make sure that your dog is not robbing you blind. All right. On that note,
she might be using the internet, because there's new stuff appearing in my house all the time. So.
Good. Blame the dog.
It's
okay.
Where we go.
A quick teaser for the next couple podcasts. We have some new guests coming on. We have a entrepreneur, small business owner in advertising and marketing coming on. I think that'll be in 2 weeks, our next podcast. A friend of mine from San Diego, great guy and very insightful. And anyway, just awesome. He'll be great. And then we're going to have a mechanical engineer on to talk a little bit about engineering. Another friend of mine from San Diego. So we've got some good guests coming on the podcast shortly. So look forward to those. And until then, we'll see you at our next podcast.